Happy Friday. Welcome to Wall Street Beats. We're going to talk financials and we're going to talk some stock technicals and momentum. I bet Bakes wants to take a victory lap on his Mag 7 call. We're officially in a bear market for the NASDAQ, down 10% from the highs. So we had a little tape bomb yesterday after the close with 10 ships for, what was that? 10 ships for 10 days, Charlie? Which the market is calling bullshit on, it looks like. I think as Charlie, we talked pre-show, Charlie said it looks like the market's getting tired of this market manipulation from Trump. Yeah. So let's jump into it. Charlie, what are you thinking about? Looked to me like KRE has been trying to hang in there. XLF has been looking pretty weak. What say you? You've been dead on these markets for the month of March. Are you still as sanguine down here, or what are your thoughts?
Yeah, I wrote a piece last Sunday. I think it was called "Edging Towards the Crash" part of this correction, and I think that's
subtle.
I haven't been doing a lot in the past week or so because I was set up for a bear market coming into March. And honestly, not a lot of my longs have worked in March. Energy, I'm very long energy. That's worked. I've been long the fertilizer stocks. That's worked. Some of the grains, but not a lot is really worked. Even trying to buy the dips is not worked. So where I'm making money these days is being short, and I think, the big down leg is about to happen here in April. So the two areas that I've been short have been financials. I've been talking about the XLF being very vulnerable, and then within the XLF, there are two specific areas that I've been short in that. Insurance, I've talked about IAK and KIE2 insurance ETFs, and they've worked here in the month of March. If you want individual names, I've mentioned AIG, which has worked. PGR hasn't really worked yet, but it's not cost me anything either, Progressive. And then on the banks, it's really been the big, trading banks that I've made money on the short side with. That's Goldman Sachs, Morgan Stanley, JP Morgan. And I think what's interesting about those names is on Wednesday, Jefferies reported earnings, and they had very robust investment banking and trading. And the report I wrote Wednesday night was about how their report signals peak earnings power. In other words, you're getting this shift from debt and FIC. FIC stands for fixed income commodities currencies. That had been driving the capital markets revenue stream over the last 2 or 3 years. And now we're seeing a shift to M&A and equity as driving the capital markets revenue stream. And it's very robust. Don't get me wrong, this is all good news. But when you get that shift from debt to equity and M&A, it marks the peak of the cycle. Now, this peak can last for a couple of quarters, and I expect it will. But the question is then, what do you want to pay for those peak earnings? And these stocks are trading at 2.5 to over 3 times tangible book, which is really very rich valuations. So I've been saying, listen, they're discounting a lot of good news. And so I think it's interesting that after Wednesday night's report, these stocks sold off, which says that people are starting to use strength to distribute into. Now, it's probably going to be a volatile topping process. So you're not going to play these things for down 50% type of cycle right now, but I think that's where you're headed over the next 12 months.
So you take any opportunity you get to sell these things on rips. You continue to be a seller.
I do.
And then you talked about the crash part of the market. Where how low do you see another 10%? What are your thoughts
so
there?
That's the second part of what I've been shorting is the SMH, the semiconductors. Okay. So I've talked about, if you look at the construct of the S&P, you've got about 46% of the market in the Mag 7s and then the XLF. And those two pieces I've talked about were starting to roll over in February, as far as I was concerned. It took a little while before you could start to see it on the charts. But now you're adding to those two pieces the SMH, the semiconductors. And that's been my more recent short, is the SMH. If you look within it, there are certain names that I think are, if you want to do individual names like Lam Research or KLAC, those I think are breaking down as well. But the point is that now you're adding to the 46% that I previously identified, that you're adding to that the semiconductors. And so that's why I think we're entering the crash part of the market, is you've just got too much weight in key sectors that are rolling over.
And what do you think is the duration? Is this kind of short term, like in the next 30 to 60 days, or you're just thinking for the rest of the year we're just going to bleed?
Couple weeks. Yeah, it's going to be, if I'm right, it's going to happen very quickly.
Got it. Okay.
Hey guys, let me cut in. Look at this. Is NVIDIA just put up?
Is there a level you're looking at to step in?
6,000 plus or minus.
Okay. On the
S&P.
S&P.
Let's go to Bake, see what he has to say.
Hey guys.
Okay. Bake, let's look at.
Hold on 1 second. I just want to mention this while I'm thinking of it, and his comments on semis.
I think
NVIDIA is taking out
Bakes,
this 169.55 level that I've talked about. It's already gone through.
Can you hear him, Charlie?
I do. Yeah.
Oh, sorry.
It's closed below the 200 day. I think this is going to be on big volume. Yeah, a little above average volume. I mean, this is I think it's the number one name in the S&P, and it's joining the part. They blew apart numbers and couldn't move the stock up on earnings day, and they sure as hell can't now that they're in a sort of a news vacuum. The deals they announce aren't working. So if this goes down, all the semiconductors are going down, and the S&P is going down, and that's a big level that we're taking out here right now in the last 5 minutes.
Yeah. So it's hard to as I said, for the month of March, none of my longs other than energy and fertilizers have worked, and I tried buying the dip in some of these software names. They bounced. You got 10%, but you had to be a good trader to make money. And the other thing that continues to act very poorly are these private equity, private credit names, which, as anybody who's been following Wall Street Beats knows, this is my universe of stocks that's going to create the crash of 1907 again. So that's the other area that continues to act poorly. So we're essentially what we're seeing is a withdrawal of liquidity. And that's a tough environment for asset prices to inflate in.
And what are your thoughts on the inflation? Like, what the effect of the Strait of Hormuz? The longer this stays closed, it looks like a couple ships from China tried to make it through this morning and got turned away. What do you think? What are your thoughts on inflation and rates and kind of higher for longer? And looks like they've taken out all the cuts, or nearly all the cuts, for the next 24 months. Yeah,
I think that the asymmetric trade on the rate side is on the long side now. I mean, the December, and I'll leave this to Ben. He's the guru on SOFR. Yeah. But I think the December 26, I think they were trading around 96.20, this morning. They look very attractive to me because you've taken out all the rate cuts. And if I'm correct, and we have this sort of crash into the spring, I think rate cuts are going to be put back on the table. And, a week or so ago, I forget when I was last on, I highlighted the potential for a negative wealth effect for the upper income levels of consumer. And we got the Z1 report subsequent to that comment that I made, and it showed another quarter of declining real estate values. So on the real estate side now, if you think of the wealth effect, there are two big asset classes that the high-end consumer depends upon. One is their real estate, their homes, or their second homes, or their third or fourth homes probably. And then the other is stocks. And about a year and a half ago, I said things like, things that need to be financed would disappoint. One of them being, real estate. and we're finally seeing real estate drop in value. So we've had 2 consecutive quarters now where the value of your real estate has gone down. Now, it's gone down very minimally. In the third quarter of last year, real estate dropped 0.3%. In the fourth quarter of last year, which is the latest data we have available, dropped 0.7%. But real estate is no longer creating that positive wealth effect.
Charlie, is that homes, the Case-Shiller index you're talking about, or real estate, including commercial, et cetera?
No, just residential. Just residential.
Okay, thanks.
Yeah. The other piece is been stocks, and stocks continue, at least through year end 25, continue to be a positive wealth effect. And so you have now about 120 trillion of net worth from just your real estate and your stocks against GDP, which is around 31.5 trillion. That's 3.8 times. And I pointed out, ahead of the great financial crisis, that ratio is about 3 times, and ahead of the dot-com bubble, that was 2.6 times. So the wealth effect today is much greater than any point in history. And it's also close to, but it's not quite back to, it's close to, as a percentage of disposable income, close to being back to the old-time highs of 2022. So that wealth effect is used to replace disposable income as a spending component. So where I want to end up with this is, if we get a stock market correction here in the spring, which is what I'm expecting, and it's fairly violent, then we're going to see that negative wealth effect in stocks join the negative wealth effect in commercial, in residential real estate that's already happening. And that will take away a lot of the consumer spend, and therefore we could be in a recession by the end of this year. So that's kind of what I'm thinking as a scenario that could
sounds like a vicious circle.
It could be, now the key is, stocks have to correct and then stay down. In other words, there's no bounce like we got in COVID, and we had that violent correction in COVID and came right back. If stocks have to stay down for that to have a permanent negative wealth effect.
So last question for you, Charlie. What's on your shopping list? We get that violent correction. What are you buying? What are you looking at first? Do you have specific names? Are you going to first dip your toes into the indices, or what are your thoughts? Or some ETFs? What are your thoughts?
Yeah, as I said, I'm already positioned in the semiconductors, the banks, the insurance, the S&P, SPOOs.
Yep.
I like the idea of incrementally buying this December 26 SOFRs. If we get this crash, I think a rate cut will be put back on the table.
Hey, Charlie, can you tell for members that aren't as savvy as you, SOFR, what does that mean, please?
It's the overnight financing rate. It replaced LIBOR.
LIBOR?
Yeah.
Okay.
A secured overnight funding rate is SOFR, SOFR. It's a short-term, interest rate that's considered fairly safe. The thing that I would do, Steve, that I haven't done yet, is look at some of these luxury consumer names, and I'll defer to Berna because she knows them much better than I do. But things like Viking Cruise Line or Ferragamo or Ralph Lauren. If we're going to get this negative wealth effect, and that's the biggest impact is going to be on the high-end consumer, then I want to start thinking about shorting some of those high-end consumer names, because I think by the second half of this year, their commentary is going to be less positive.
Okay. It's a great thought. All right, Bakes, let's go to the charts. Where do you
first
want to
one,
start?
since I wanted to segue from Charlie, is Citigroup. And I have been, trying to, I hope I've been helpful. You having Charlie to sell less or sell higher or what have you. This is the 140 level I've been talking about forever. This goes back to, this is the swoon that you saw in the great financial crisis. And when we took out this 80 level, this is Luis Yamada stuff, big, beautiful base. And I have the same kind of rationale that I did with silver. If you're under this level for 17 years and you break out of it, I just don't see the reason why you break down through it given the transformation that Citigroup has undergone. And, when now 140 might feel like a long ways away, but it's $30. It isn't really that much. And Charlie has forgotten more about this name and knows the catalyst that can get there. But I couldn't put them on the same chart because I don't have the patience. But stare at this chart. I'm going to give you the daily, okay, of Citigroup. Look at the relative strength. That's 84, okay? And it's not that far off the high from the relative strength, okay? And the recent high is at 125.16. This is a pretty orderly correction in the grand scheme of things. Now, here's the granddaddy of them all. Look at JP Morgan. The relative strength is 43. The relative strength line has deteriorated dramatically. It didn't come close to matching the taking out its previous highs. Earnings were given a Bronx cheer, and just look at the difference. Oh, by the way, here we have the close below the 200 day. That's a sell a third for the bake sell signal. Here's the 50-day coming down through the 200. So you should have been out of this at 300 plus, in my opinion. And now we're going to look at this 200-day to see if that goes down. But I'm struck by, and Wells Fargo looks the same, Charlie. Citigroup is holding in like a champ, absolutely like a champ. And kudos to you. You've been in this since the mid-40s, I believe, and mid-40s to 110 makes a lot of money for members.
Yeah, I endorse wholeheartedly what Bakes just put on out there. I think Citi, I'm waiting for it to come back to 100. If I buy some more. Bakes, you have done a good job of keeping me in the trade, so thank you. Because I'm usually too early in and too early out. But I'm waiting for that 140 level, Bakes.
And I don't know if the the Mexican spinoff or wealth management or what the catalysts are. 105 and 102 is a decent band for this to come into. Yeah, you can get 100, but 102, 105 is kind of where I see a lot of good support here. This is a pretty breakout here back in December of last year. So, but I'm really struck by, it looks better than all the other names, the Goldman Sachs, the Morgan Stanleys, and their big bank brethren. It just really caught my eye last night when I was going through it.
Yeah. And your comment about JP Morgan is absolutely right. I mean, I think the golden cross on the upside was back in 22, and now we're seeing the golden cross on the negative side. I think this stock, and this is the lead steer for the industry. It honestly, it has got the best balance sheet, the best franchise, the best management, but that doesn't mean the stock is attractive.
And we all know that, and everybody knows that. And CNBC genuflects to Diamond, and I think that's over. At least for a while. Yeah.
But, so this is a name that, I would be on the short side going into the spring, because I think there is a capital markets event that's about to happen. And we're going to see, headlines on the front page of the Wall Street Journal that read hung loans. Hung loans will tell you that liquidity has just disappeared and that the buy side no longer wants to take risk. And that's what, there's so much optimism. After the Jefferies report, I think everyone came out and said, oh, we're going to have great first quarter earnings. Capital markets revenues are going to the moon. And yet the stock sold. I just think there's just so much optimism that the peak earnings power has been discounted, at least at these prices.
And this is
10 or 20%, maybe if we buy them.
And this has been such a safe haven trade too, Charlie. If the market's looking for liquidity, they're pulling it out of here, they're pulling it out of Mag 7. This is one of the places where you're going to go in addition to your gold, which we've seen some pressure on lately.
Yeah,
as well.
Yeah,
Charlie, I just saw a headline that Anthropic is going to go public in the fourth quarter, and what a coincidence! They put out cloud announcements every 11 minutes, it seems like, as to which industry they're going to decimate with their lower cost AI solutions to fintech, to lawyers, to damn near everything.
Yeah,
and I'm curious to see. Sorry.
So this morning it's cybersecurity.
And I talked about CrowdStrike a little while ago, which was, oh, nobody rips out security. Well, at 103 times earnings, CrowdStrike can't say anything bullish enough to turn this chart around. And it's just look out below. The volume's monstrous. There's a new announcement today about CrowdStrike from another Anthropic offering, Mythos. Zscaler's down. All the security guys are down. And, this won't hurt them that much. Refrain is very scant comfort when you go from 566 down to 365 a share. And that's what we're all here for, is to make money in the stocks, not justify our bullish positions, in my opinion.
Yeah. I can speak very eruditely. Is that a word? Eruditely? I don't know. Anyway, about financials and all the reasons why you want to own financials over the long term, but that's not going to make you money over the next 3 to 6 months, I don't think.
Exactly. All right. Hey, Bakes, can you pull up Meta? I suspect there's a lot of viewers sitting on that in their portfolio and wondering WTF these past few
Well,
weeks.
I mean, if they are, they haven't listened to our show and taken our advice, or my advice at least.
Amen for that.
And here's the broken record. And I got to tell you, this is, so fortifying that when I go through my charts every night, I know exactly what I'm going to do at the open the next morning. And I can't own individual names, full disclosure, but this is just clear as day. A gap down on earnings, which means people don't like what you had to say about CapEx or anything else. This is back in October at 666. That's sell a third. The 200 days starts going down here, 1107. The November of last year, 621. That's the stock price. So that's what an average is, 630, give or take. And then the 50-day comes down through here at 673. So you're out at around $650. I didn't do the math, but I'm rounding and coming close. And you're out of this name at the end of last year. This you probably said, "Oh, Bakes, you're an idiot. You missed this." Okay, but I also missed this. And when it started taking out this 600 intermediate low in January, I said, "You got problems here." And I didn't, I didn't have the excuse of a bad legal outcome to drive this thing down. But I don't care. I mean, that's a good thing about technicals. It's, the market's telling me something's wrong, and then the newspaper will tell me after the fact what was wrong. And so the next thing you're going down to is 479, and this support is not going to catch this, move that's on, 1.5 times normal volume. With a relative strength of 20, we took out the relative strength line. This is the monthly. And the reason I think I brought it up before, Stephen, was if this keeps going, their next earnings report, they're going to say, hey, you know what, CapEx, we're going to do the low end of the number. And then it ripples through NVIDIA, et cetera. Exactly. And I think that's becoming more and more likely, even than when I talked about this, I don't know, 2 weeks ago, something like that.
And that's the nuance that Charlie didn't tell you when he was talking about getting short SMH. Is these stocks start to lose their mojo, and they're going to start cutting CapEx.
That's what I think. That's what, and that's about as fundamental as I'm going to get. But that just seems, that's what they did when they changed the name to Meta. They said, we're going to take our virtual reality stuff and augmented reality stuff. We're going to dial that down, and the stock loved it. And now they were applauded. I'll go back to Meta for a second. They were given, high praise and applause when, the day of the year of austerity, right around here.
Yeah.
But then they started spending money on data centers, and people liked it until they don't. And Steve,
Steve, you made a very important point about CapEx spending. You know, a lot of people thought we would be in a recession a year ago or 2 years ago, but it was the huge CapEx spending by the hyperscalers that prevented that from happening. So if we do get that reduction in CapEx spending on top of the negative wealth effect, then I'm almost sure by the fourth quarter we'll be in a recession.
Yep.
Well, and the problem with that is the stocks bottom when the recession's announced. So, you've got to be getting out of any names that look like this and look like Meta. I mean, frankly, you should have got out by the end of last year and avoided this 3 months of fiasco. But
so for those that like to try to buy dips, this is not a dip. This is not a dip Meta you'd be buying yet.
Not even a little bit. I mean, if they,
if they can recapture that.
Could they bounce to this 581 where this broke down? But I mean, we had a gap down through 581. 581 didn't even serve as support. So if you see anything with a 560, 570, on a bounce, shoot this. No, I'm just
How
serious.
do you really feel, Bakes?
It's
get the fuck out. Pardon my French.
These are stocks. There aren't people. They're not friends. And getting emotions out of this game is I think vitally important. And it took me, I don't know, 15 years to beat it into me, and then the next 15 were a lot more fun.
Amen.
I got a couple more. You got some time?
Yep. Okay. We got one more.
And I'll get. Let me give two more, but I want if you go through anything you want to cover too. This is okay. That's the wrong one. This is YXI. This shorts the big China stocks. Look at this. Full disclosure, I'm waiting for one technical indicator that I'll show in the member chat. But this is looking very promising. This shorts BABA and
what's the ticker?
This is sorry, YXI ProShares short Xinhua China 25.
Got it.
And it shorts the BABAs of the world, and to those that accuse me sometimes of just catching high flyers. I mean, this is down from what is that, 80 something, $100 at the zenith, and here we are at 22. And again, this is about as fundamental as I get. We control or influence or blowing up much of China's oil supply in Venezuela and Iran. And things are going to be tough for them for a long time. The BABA report, people hated. Look at this thing. I don't think that's going to find a bottom anytime soon. So take a look at this. I'll let you know in the chat when I pull the trigger again. I'm waiting for one part of my discipline to trigger this. But get this on your radar screen. This is YXI shorting China 25. And another one that I'm looking at, and it's getting closer by the minute, frankly.
While you pull that up, Bakes, I want to ask Charlie something.
So yeah, sure.
We've got, or maybe both of you, we've got Trump meeting with Xi in a couple weeks. I mean, doesn't he need to get this Iran thing wrapped up before that meeting? Given what Bakes has just said, like China's economy is in real trouble here if they don't get that Strait of Hormuz open.
I thought he delayed that.
He did. No? He delayed it He delayed. It was supposed to be, I think, the end of the month or the first week of April, and then he pushed it back 2 weeks.
It's going to be a frosty meeting.
Yeah,
if it happens.
The Xi meeting is May 15th or 16th, somewhere around there.
Oh, he pushed it out another month. Okay.
Yeah. The delay in bombing Iran's infrastructure has been pushed off to April 6th, I believe.
Yep.
So he's got some time between April 6th and the May meeting with Xi to do
get this thing wrapped up. Okay. All right. Sorry, Bakes.
No, that's good.
I had my day strong.
This is my last one. This is SARK, S-A-R-K, the trader one-time short innovation for legal reasons. They can't say we're shorting Kathy Wood and her stocks. But that's exactly what it is. It's an inverse, a daily inverse of shorting, her main names, which are Tesla, CRISPR, Circle, Tempest, Coinbase. And that makes up, I don't know, 40% of the fund, something like that. But 3480, again, members, look in the chat, and I'll let you know when I pull the trigger on this. I've got a little bit of a soft spot here because this is one of the main reasons why I made money in 22 with the S&P down 20%. In 22, caught much of this back here. So this, and then I don't see why we can't do that again. So this is, my self-discipline got me out here back at the end, avoid all this. And this is what you're shorting is, and this is Kathy Wood's fund, ARKK, and nothing personal. I'm like Abe Vigoda. It's nothing personal. It's just business.
That doesn't look good.
But we're taking out 65.98 today, and that's bad. It's just bad. And Tesla, the mothership, that looks bad. And did you have valuation support at 223 earnings? Nope, you don't.
All right. So we're not shedding our bear suits quite yet.
Not even a little bit.
Not even a little bit. No.
Okay. All right, let's wrap it up there, gentlemen. We'll give everybody their Friday back. Thanks everybody for joining us on Wall Street Beats. Follow us on wallstreetbeats.com. Enjoy your weekend. We will see you back here on Monday. Thanks, guys.
Thanks all. Thanks, Justin.
Great show.
Yeah, thanks,
Take
Justin.
care.
Thanks, Justin.